Imagine for a second that it is September 15th, 2008. You're standing on the floor of the New York Stock Exchange. The air smells like sweat and panic. Lehman Brothers has just filed for bankruptcy. Merrill Lynch has been sold in a fire sale. The Dow Jones is free-falling, and the global financial system is seizing up like a car engine with no oil. You look at your screen and you see red. Every major bank in the Western world is on life support. The Americans are printing trillions. The British are nationalizing their banks. The Icelanders have literally gone bankrupt as a nation. But then, you look north, you look at Canada, and you see nothing. No bank runs, no closures, no tearful CEOs begging Congress for money. The Canadian banks are just opening their doors at 9 a.m., selling GICs, and closing at 5 p.m. It was so calm that Fareed Zakaria called Canada the moral superpower of the crisis. The World Economic Forum ranked Canada as banking system number 1 in the world for soundness for 6 years straight. While the American financial house was burning down, Canada was sitting on the front porch, sipping at Tim Hortons, wondering what all the fuss was about. But why? Was it luck? Was it politeness? Or was it a ruthless, calculated economic machine disguised as a friendly neighbor? Today, we are going to dissect the Canadian miracle. We are going to look at the 5 pillars that turned a frozen backwater into the global fortress of finance. And be warned, the story isn't just about being nice. It's about monopolies, harsh government austerity, and a regulatory stranglehold that would make a libertarian scream. Buckle up. We're going to find out why boring is the new rich. To understand why Canada survived, you have to understand the fundamental difference between Main Street USA and Bay Street Canada. In the United States, banking has historically been an experiment in chaotic freedom. The US has a tradition of unit banking, small local banks serving local communities. Before 2008, the US had over 8,000 distinct banks. It was a fragmented, hyper-competitive jungle where everyone was fighting for scraps. The Canadian banking system is dominated by the Big Five: Royal Bank of Canada, RBC, TD, Scotiabank, BMO, and CIBC. These 5 giants control roughly 90% of the market. In the US, competition drove banks to take insane risks. If the bank across the street starts offering ninja loans, which means no income, no job, no assets, you have to do it too, or you lose market share. It was a race to the bottom. In Canada, the Big Five didn't need to race anywhere. They had a captive audience. Because the system is so concentrated, the banks effectively operate as a protected oligopoly. They didn't need to gamble on subprime mortgages to make money because they were already making billions charging Canadians $15 a month for a checking account. This concentration created a too big to fail culture before the phrase even existed. But unlike the US, where too big to fail meant take risks and the government will save you, in Canada, it meant we are the system, so we better not break it. The Canadian banks knew that if one of them went down, they all went down, so they policed each other. It wasn't a free market, it was a mutually assured survival pact. While American bankers were cowboys shooting from the hip, Canadian bankers were accountants checking the math 3 times. And in 2008, the accountants won. Now, let's talk about the weapon that killed the American economy, the mortgage. In 2007, getting a mortgage in the US was easier than getting a library card. You had teaser rates, interest-only loans, and the infamous subprime market where mortgages were sliced and diced into toxic securities. But the real poison in the US system was a legal quirk called non-recourse loans. In many US states, if you can't pay your mortgage, you can simply mail the keys to the bank and walk away. The bank takes the house, but they can't come after your other assets. They can't sue you for the difference if the house is worth less than the loan. This encouraged speculation. If housing prices go up, you get rich. If they go down, you walk away. Heads I win, tails the bank loses. In Canada, mortgages are full recourse. If a Canadian walks away from their mortgage, the bank takes the house. If the house sells for less than the loan, the bank can sue you for the rest. They can garnish your wages. They can take your assets. They can ruin your life for a decade. This simple legal difference changed the psychology of an entire nation. Canadians didn't treat houses like stock options. They treated them like liabilities. On top of that, Canada had a secret weapon, the CMHC, Canada Mortgage and Housing Corporation. In the US, mortgage interest is tax deductible. The government literally pays you to take on massive debt. In Canada, it is not. Furthermore, in Canada, if you have a down payment of less than 20%, you are required by law to buy mortgage insurance from the CMHC. And who pays for that insurance? You do, the borrower. But who does it protect? The bank. If you default, the insurance pays the bank back. This insulated the Canadian banks from the housing crash. The risk wasn't on their balance sheets, it was on the borrowers and the government insurer. So while American banks were holding bags of toxic subprime excrement, Canadian banks were holding fully insured recourse loans backed by the wages of terrifyingly polite citizens. If you want to pinpoint the exact mathematical reason Canada survived, you have to look at a boring government agency called OSFI, the Office of the Superintendent of Financial Institutions. In the US, banking regulation was a patchwork mess. You had the Fed, the SEC, the FDIC, the OCC, and state regulators all fighting for turf. Banks could shop for the friendliest regulator. In Canada, there is one sheriff, OSFI. And OSFI had a rule that saved the country. It's called the leverage ratio. Leverage is basically how much money a bank lends out compared to how much it actually holds in its vault. In the run-up to 2008, U.S. investment banks like Lehman Brothers were leveraged 30 to 1 or even 40 to 1. That means for every $1 of their own money, they were gambling with $40 of borrowed money. If the market drops by 3%, they are bankrupt. European banks were even worse, some leveraged 50 to 1. But in Canada, OSFI imposed a strict assets to capital cap. Canadian banks were legally restricted to a leverage ratio of 20 to 1. They literally could not gamble as hard as their American cousins, even if they wanted to. When the global credit crunch hit, U.S. banks didn't have enough capital to absorb the losses. They were naked. Canadian banks, forced by OSFI to keep their clothes on, had a buffer. They had an average asset to capital multiple of around 18 in 2008. It wasn't that Canadian bankers were smarter. It was that their parents, OSFI, wouldn't let them play with the sharp scissors. Now, we have to travel back in time. Because the reason Canada was strong in 2008 wasn't because of what happened in 2008. It was because of what happened in 1995. In the early 90s, Canada was an economic basket case. The Wall Street Journal published an editorial calling Canada an honorary member of the Third World. The debt to GDP ratio was nearly 70%. The deficit was spiraling out of control. Canada was hitting the debt wall. Enter Paul Martin, the finance minister under Prime Minister Jean Chrétien. In 1995, Martin presented a budget that was absolutely brutal. He didn't just trim the fat, he amputated limbs. He cut federal spending by billions. He slashed transfer payments to the provinces for healthcare and education. He fired 45,000 civil servants. He cut business subsidies by 60%. He famously said he would balance the budget come hell or high water, and he did. By 1997, Canada had a budget surplus. They started paying down debt aggressively. This fiscal turnaround meant that when 2008 hit, the Canadian government had pristine balance sheets. They had the fiscal firepower to launch stimulus packages without panicking about national bankruptcy. While the U.S. was terrified of its rising debt, Canada entered the crisis with the lowest debt-to-GDP ratio in the G7. They had already taken their bitter medicine a decade earlier, so they were immune when the plague arrived. Now, here is where we have to be cynical historians. The official narrative is that Canada had no bailouts. Prime Minister Stephen Harper said it. The banks said it. It became a point of national pride. We didn't need taxpayer money. Well, that's not entirely true. While Canada didn't have to buy equity in failing banks like the U.S. did with TARP, Troubled Asset Relief Program, the government absolutely turned on the fire hose of liquidity. It was called the IMPP, the Insured Mortgage Purchase Program. In late 2008, the credit markets froze. Even healthy banks couldn't get cash. So, the Canadian government, through the CMHC, stepped in and bought $69 billion worth of mortgages from the banks. The study, The Big Banks, Big Secret, by the Canadian Centre for Policy Alternatives, claims the total value of support, including liquidity from the Bank of Canada and the U.S. Federal Reserve, peaked at $114 billion through. At one point, 3 of Canada's banks, CIBC, BMO, and Scotiabank, were receiving support that exceeded the value of their entire company. Now the banks will argue this was not a bailout because it was a loan and a gimme swap of assets, and they paid it all back with interest. And they are technically right. The taxpayer didn't lose money, they actually made a small profit. But let's be real. If the government hadn't stepped in to swap cash for mortgages when nobody else would buy them, the Canadian system would have seized up just like the American one. It was a stealth bailout. It was elegant, it was profitable, and it was quiet. But it was a lifeline nonetheless. Mark Carney, the governor of the Bank of Canada at the time, slashed interest rates and flooded the system with liquidity, assuring the markets that we will do whatever it takes. And because the banks were fundamentally solvent, thanks to Pillars 1, 2, and 3, the liquidity support worked perfectly. So Canada survived. No banks failed. The recession was shorter and milder than in the US. We patted ourselves on the back and lectured the world on how to run a financial system. But there is a dark twist to this story. Because Canada avoided the crash, it also avoided the correction. In the US, housing prices collapsed. The bubble burst. It was painful, but it reset the market. Housing became affordable again for a while. Deleveraging happened. In Canada, the bubble never burst. It just kept inflating. Because Mark Carney slashed interest rates to emergency lows to save the economy, borrowing became virtually free. Canadians looked at the stability of their banks, looked at the low rates, and said, let's buy houses. The moral hazard that the US dealt with in 2008 was simply kicked down the road in Canada. By avoiding the pain of the great financial crisis, Canada inflated a housing balloon that is now one of the biggest in the world. The boring fortress worked so well that it convinced an entire generation that real estate never goes down. In 2008, Canadian household debt was lower than the US. Today, it is significantly higher. We didn't solve the debt problem. We just transferred it from the banks to the citizens. So, did Canada avoid the meltdown? Yes. But in economics, there are no solutions, only trade-offs. Canada traded a financial crisis in 2008 for an affordability crisis in 2024. The story of Canada's 2008 survival is a masterclass in risk management. It shows what happens when you have a regulatory system that prioritizes stability over innovation. It shows the power of having a government that balances its books before a crisis hits. And it proves that sometimes being a boring, oligopolistic, rule-following buzzkill is the smartest strategy in the room. But it also serves as a warning. Success breeds complacency. The very policies that saved Canada, cheap credit, government-backed mortgage insurance, and a protected banking sector, have planted the seeds for the next crisis. The alien historian looking down today wouldn't see a burning house in Canada, but they might see a house made of glass waiting for a stone. If you want to understand how that housing bubble eventually pops, make sure you subscribe for our next deep dive into the Canadian real estate trap. And let me know in the comments, would you rather have the American system of boom and bust, or the Canadian system of stability and expensive houses? Thanks for watching. Stay safe, stay skeptical, and keep your leverage ratio low.